Hello everyone and welcome to another accounting lesson. Today we'll be covering what is the valuation method or rule for inventory in the statement of financial position. So from the rule mentioned, inventories shall be valued at the lower of cost and net realizable value. So what is the meaning of cost of the inventory? It is simply the total purchase price of the goods, which include items such as transportation and insurance. However, there's a new term for us to learn today, which is the net realizable value. Net realizable value simply means the estimated selling price of the goods in the very near future. So at this point in time, the business has not sold any of their inventory yet. To give us an example, let's look at a case where a business is selling toys such as fidget spinner. Suppose the business has purchased these fidget spinners for $1,000 previously, and the business got some information that these fidget spinners in their warehouse can only be sold at $800. This is also known as the net realizable value or the estimated selling price of these fidget spinners. When a situation like this happens, the business would need to record a transaction, also known as a write-down of inventory. When there is a write-down of inventory or write-down on inventory, what we need to do is to recognize that there is a loss that the business would take today, and this account called impairment loss on inventory will be recorded. Impairment loss on inventory is an expense, and this account will be opened up, and the other account that is paired with it will be to reduce our inventory account. As you can see, the difference here is $200, and we would need to bring down inventory by $200. Therefore, if we were to observe what is going to be presented in the statement of financial position during that year would be in the current asset section, we would see that we will have inventory being presented, and in inventory account, instead of having the original $1,000 of inventory being shown, we would now need to record the lower of the cost and net realizable value. Therefore, the inventory account would only be shown as $800 in the statement of financial position. The reason for doing so is in line with the valuation of inventory related to the prudence theory. According to the prudence theory, all estimated or possible losses are to be recorded so as to avoid overstating the amount of assets in the business or income in other cases. Thank you for watching this video, and I'll see you in the next video. Goodbye.